Hello friends, I'm Aniket. Welcome back to my YouTube channel Behind the Stock. Friends, this is my new channel about the stock market. If you want to detail information on the stock market, investment strategies and financial news, then you have come to the right place. On this channel, we will go deep into the details of stock market trends, learn different ways of investments, and understand how to market and money works. In the upcoming days, I will be posting important videos, so stay tuned. So friends, today I am going to discuss the most important principle of technical analysis. This principle should be learned first before enter the stock market. But people don't give much importance to learn this topic. Now we are going to discuss our first chapter, Dow theory. If you have studied the technical analysis and you don't know about the Dow theory, then friends, you have missed the most important part of stock market. According to me, while learning basic, first of all, Dow theory should be the first chapter while learning technical analysis. This theory divided into two categories, basic and advanced. First I am going to start with the basic and then we will discuss the advanced as we gain the experience. Without experience, advanced technical analysis will be very difficult to understand friends. Even if you learn, you will not able to figure out what is going on. It's not that easy because it's require at least 4 to 5 years of experience guys. Friends, stock market is a very strong psychological subject, but it also plays with human psychology, emotions and sentiments. You can learn all these things in this theory. Let's start. Friends, before we start our new video, don't forget to subscribe this channel and please like and share with your friends. Dow theory was developed in 19th century by Charles Dow. This theory has been around for almost 100 years. Yet even in today's volatile and technology-driven market, the basic components of Dow theory still remain valid. If you watch this video, you will notice that this theory works accurately even today. Friends, if you understand the concept of the Dow theory, at least 40 to 50% of your market psychological problem will be solved. Charles Dow developed this principle over the year of his observation on the market. Let's see what are these principles. First, market discount everything. Guys, if you remember, I have made a video on this concept. Do you remember that? If you watch my previous video, I have discussed this concept by giving example while analyzing fundamentals of Vedanta company. However, I am going to discuss this subject once again, taking some other examples, so you can understand everything properly. These are very interesting examples, friends. You can relate it. Second, market trends. There are three broad market trends. First, primary trend. Second, secondary trend. And third, minor trend. You will learn how to identify the market trends. Friends, whenever I will make a video on this topic, please watch it because this is going to be very informative video. Third, index must be conformed to each other. Fourth, volume must be confirmed. The volume must be confirmed along with the price. We have also discussed this topic in our previous video. Why volume is important for me, you will understand when we discuss this topic in detail in my new video. Fifth, market can remain sideways. Market may remain sideways, friends, means trading between in the range for an extended period. Those who are long-term investors, they have to learn this concept. I will make a detailed video on it. This topic is also interesting to learn. Sixth, closing price is the most important thing. Means the closing price of the market. Our market closed at 3:30 p.m. And last, seventh, price tendency confirmation. Friends, we are going to discuss all these principles step by step. It will be difficult to discuss in this single video. So I am going to make these videos in some parts. Let's discuss the first principle, our main point. Market discount everything. Friends, market knows everything. And who is the market? Institutional investor, friends. Means foreign institutional investors, domestic institutional investors, and big hedge funds. Foreign institutional investors are those investors which invest in the assets belongs to a different country. Other than that, where these organizations are based. Means they are foreigners, but they invest in the Indian stock market. On the other hand, domestic institutional investors, they are domestic investors, means Indian investors who invest in Indian stock market. Guys, these investors knows everything before us. Means every news about the market, every news about the country. They knew before retail investors. We are retail investors. They all know everything before us. We are nothing in front of them, friends. Always remember, these investors operate the market, not us. Now, friends, what we can do? As a retail investor or trader, you can follow the footprint of these investors' data, means information, friends, and you can understand which security they are buying and selling. Security means stocks, friends. These data tell the liquidity and strength in the stock market. You have to study their data before take any action. You can follow their footprint, and you can find this data on website of NSC and BSC. These are our stock exchanges, friends. Now let's start our main topic. Market discount everything. Discount. Discounting means something that the market already knows. When we see the news and we go to the buy that stock, and the chart shows that the stock is already moved upside by 10 to 15% before the news, guys. How is it possible? Friends, if you have at least 2 years of experience in the market and you always study the charts, then you must have experienced one thing, that is the company stock price already move upside or downside by the 10% or 15% before the company declaring the result. Or suppose the result of that company is declared today, but if you look at the price of that company has already increased or decreased. And one more thing, friends, when the company declares the result and even the company is in profit, but the price has gone down, even showing positive result, price has gone down, friends. Why? Have you noticed, have you experienced this? And what is the reason behind it? Because the information of that company already leaks in the market and investors have already played their game. Now friends, let's take the first interesting example of this topic, Nifty in COVID period. I have some question for you, friends. First, does anyone remember the market crash during the COVID period? When the market crash, do you remember? It's on 9th March 2020. It's a date when the market crash. Second question, tell me, when the lockdown was announced, when did the government announce the lockdown? Look here. See, Indian government has announced the lockdown on 24th March, correct? Fine. Means market crash before the announcement of the lockdown. What I say? Market crash before the announcement of the lockdown. Now important question. Third question. When the Nifty touch its bottom during this period? It's again 24th March, the same day when lockdown was announced. Do you understand what happened here, friends? Listen carefully. On 24th March, two things happened. First, lockdown announcement, and second, Nifty also touched its bottom on the same date. And my last question, tell me friends, do you know when the Nifty start moving upside? Upside, friends. It's 25th March, friends. 25th March, next day after the lockdown. Friends, usually market crash or moving downside after the bad news comes. Don't you think something went wrong here? Now friends, again listen carefully what exactly happened here. Means on 24th March, lockdown start, and very next day on 25th March, market start moving upside. Can you believe it, guys? How can it possible, tell me? After lockdown, how can market move upside? Lockdown announcement is a negative news for the market. It means after negative news, market start moving upside, friends. Now look at the chart for your better understanding. First, market crash on March 9. Look here, like this way. Second, government has announced the lockdown on 24th March. Here. And also Nifty touched its bottom on 24th March, the same day when lockdown announced. And the last fourth, Nifty start moving upside on next day after lockdown announcement 25th March. Is it logically correct, friends? What do you think about it? Let's discuss what common people, means retail investors, think in this situation. First, lockdown will announced, means all industries, IT companies will be closed, and then market will crash. And after some time, the lockdown ends, Nifty will start moving upside. Simple. Friends, most retail investor was thinking it should be happen like this way. Market supposed to crash on 24th March when the lockdown was announced instead of 9th March. But reality is different. It's not like what people think. Reality is market crash on 9th March before 15 days of the lockdown. Now the answer of all this question, institutional investor, friends. Institutional investors sold all their positions before the lockdown. But why? And how did they know the lockdown will announced by the government? Because market never works in present. Institutional investor always thinking about the future. These institutions already knew that coronavirus is very dangerous thing. Government can announce lockdown in future. Friends, they have strong links with government. Institutions have lots of resources. These resources are continuously working to get all those news to them, and somehow they can manage to identify which news government will going to announce in public domain. They are trying very hard that they should know every news before comes in a public domain, means in newspaper and channels. Most of them may have links with officials, I don't know, and because of these reasons they are always ahead of retail investors. That's why they already started selling all their positions. Look here, selling a stock at a higher price, and who is the buyer? Of course, retail investors, friends. And then buying it at a lower price from again retail investors. It's a very smart move by the institutional investors. So friends, always remember, the market discount everything. Market discount everything, friends. Friends, if you want to see when and what these investors do, then as I mentioned earlier, all this data is available on NSE and BSE website. You can study this data before taking any action. It will be beneficial for you, friends. Now friends, let's take another example of this topic. Paytm. You all know this company, friends, because lots of you got its IPO. Company's IPO is available to everyone. Friends, I will explain in detail what is the meaning of it when I make a video on this topic. Now look at the chart. Look here, friends. The day Paytm company was listed in the market, the price had gone down before negative news comes in the market. On the same day itself, the stock is going down. And if you look here, you will see that right now the price is down minus 80%, almost 80%, friends. Now friends, that means those who have invested 10 lakhs in this company, so now they have only 2 lakhs rupees in their hands. 80% loss, friends. It's a huge loss. What do you think, guys? Who is in that 80% loss? Market? Institutional investors? No, friends. Only common people. Retail investor lost their all 18% of money. The reason is simple, friends. This company was a loss-making company even before it was listed in the market. There are many reasons, friends. Fundamentally weak company, like poor financials with negative cash flow, loss-making company. The market already knows all these things. That's why they started short selling on the listing day. And due to all these reasons, the price went down. Tell me friends, what do you think? How many people have done fundamental study of this company before listing in the market? And the answer is most of the retail investor does not study the result even of the listed company. So how will they think about unlisted company, right? Friends, institutional investors already knows that the most of the retail investor does not study the market. That's why institutions are always in the profit. Friends, before going for any IPO, first you have to get detailed information about that company. Do a fundamental analysis and only then go for that IPO. IRFC, Indian Railway Finance Corporation. IRFC is Railway Finance Company. The stock increased 5 times, mean 500% friends. And within a year, before the news comes in the market, look at the candle and volume. Look here, this stock was listed on January 2021. Till 1st June 2023 means 1.5 years, there was no movement in the stock. Because of that, many people cut their positions, or some people thought that this stock is useless, so they did not invest in it. Friends, this is the game of the market. As I said, market plays with our sentiments. Always remember friends, institutional investors makes money without letting anyone know anything. Now this is interesting part. If someone had invested 10 lakhs in the stocks, by now it would have been 50 lakhs. Means 500% friends. 500%. Even bank takes 20 to 30 years for this to make 5 times. But this stock did it in 4 years. In 4 years, friend, with strong fundamentals. I'm talking about from listing day. But if you look here, this stock actually increased only in 7 months. Capital increased by 5 times only in 7 months, guys. And for that, the investor had to wait for 4 years. 4 long years. Just think about those people who have been patient for 4 years, friends. They are in huge profits right now. Remember, this stock was not a penny stock, which are randomly moved up or downside by the operators. What do you think, friends? Why those people have left these stocks? Because, friends, people thought that the stock was listed at rupees 26. Stock price is very low, and that time people thought that they can trade in this stock. But friends, what is one main thing they forget? That is, the stock is government stock. It's not a private stock. And in government stock, big investor invest their money for a long term, not for a trading. This stock has not moved for 2 years. So people sold all their stocks. And taking advantage of this situation, institutional investor made their investment at a low cost and their money increased by 5 times, friends. Now you know what went wrong here. And second, what was the reason behind it? Let's find the reason. Why this company made us to wait for 4 years and increase 5 times in 7 months? Because friends, institutional investors already knows that the company has strong growth prospects. And what does the IRFC do? This company raise funds for investment in the Indian Railways and arrange the funds for the infrastructure projects of railways. And that time, according to report, IRFC is planning to raise up to 25 billion. 25 billion were going to be invested in Indian Railways by this company. Now tell me friends, who knew what was going to happen in this company before this news comes to public domain? Correct. Institutional investors. Institutions already knew about this. It's a game of the market, friends. As I said, institutional investors makes money without letting anyone know anything. And what we learn in the overall trend of IRFC company, if a company has a strong fundamentals and look like it will survive for at least the next 10 to 15 years, then it is important to stick with that company. And one more thing, guys, investment and trading are two different things. The nature of investment and trading stock is very different. You have to understand this. If you start trading in investing stock, then you have to wait for a long time to achieve the intraday target. And in the other hand, and if you go for an investment in trading stock, it will be difficult to achieve your long-term target because these stocks are very volatile. Always remember friends, first check the type of that specific stock before take any action. Now friends, how can we predict the news before it's widely known or discounted by the market? It's a challenging task friends. Here are some strategies that retail investors and analysts may use to try to get ahead of the market news. First, follow industry trends. Friends, this concept I will cover on indexed must be conformed to each other and market trend videos. Second, monitor economics indicators such as GDP growth, inflation rates, and interest rate. It can help investors to stay ahead of the market moves. Third, use technical analysis. Fourth, most important to understand the market psychology. Market sentiments and investor psychology play crucial role in driving market movements. By understanding the emotions and behavior of market participants, investors may be able to identify potential market of moving events. Friends, what we learned in today's video. First, any kind of news is discounted before it comes in the public domain. All the information about a company or an industry is already reflected in the stock price. Retail investor can analyze past market data to try to predict future market. To understand this, you need to study industrial trends, economic indicators, and technical analysis. Second, you should have patience in long-term investment. Institutional investor will never tell you when a stock is going to increase by 5 times. And for that, you need to patience and learn advanced price actions. Third, if the performance of the company is already poor and fundamentals of that company are also showing weakness, so it would be beneficial to stay away from that company. So friends, if you like today's video, please comment and tell me. If you have learned something new from this video and want to know more about the stock market, please subscribe my YouTube channel Behind the Stocks and share it with your friends and family members. Thank you. See you again.